In December 1989, the Nikkei stock index hit 38,915 points. Japanese real estate was so valuable that the Imperial Palace grounds in Tokyo were worth more than all of California. Businessmen bought Van Gogh paintings with corporate credit cards. Golf club memberships sold for $3 million. By 1992, $6 trillion in market value had vanished. Banks that had ruled the world became zombies, shuffling through decades of debt. The miracle economy that rebuilt itself from atomic ashes became a cautionary tale about the difference between wealth and illusion. What destroyed Japan wasn't war or natural disaster. It was something far more dangerous, the belief that prices could only go up. This is another story where money, power, and history collide, and nothing is ever as simple as it looks. The story everyone knows goes like this: Japan got greedy. After decades of disciplined growth, the nation fell victim to speculation and excess. Real estate and stock prices inflated beyond reason. When reality returned, the bubble burst. This version satisfies our need for moral clarity. Greed leads to punishment. Markets self-correct. Bubbles always pop. The truth reveals a more troubling system. One where central banks, political pressure, and international agreements created conditions that made madness seem rational. Where the very institutions designed to prevent excess actively encouraged it. Japan's bubble wasn't born from irrational exuberance. It was manufactured by policy. The mechanism began in 1985 with the Plaza Accord. 5 nations gathered at the Plaza Hotel in New York to solve America's trade deficit problem. Their solution was elegant: force the dollar down and push other currencies up, making American exports cheaper and imports more expensive. For Japan, this meant the yen would rise dramatically against the dollar. Export-dependent Japanese companies faced potential devastation as their products became uncompetitive overnight. The Bank of Japan had a choice: let the economy contract or flood it with cheap money to offset the currency shock. They chose the money. Interest rates fell from 5% to 2.5% by 1987. Money became almost free. Banks, facing pressure to lend and borrowers eager to spend, created a perfect storm of liquidity. But cheap money needs somewhere to go. Japanese manufacturing was already efficient. Consumer spending was constrained by cultural savings habits. The excess flowed into the only assets available in sufficient quantity: real estate and stocks. The government didn't just allow this flow. They encouraged it. Tax policies favored real estate investment. Financial regulations permitted banks to count unrealized stock gains as capital, meaning rising share prices let them lend even more money. Zaytech became the buzzword of the era. Major corporations discovered they could make more money speculating in financial markets than manufacturing products. Toyota's financial division generated more profit than selling cars. Borrowed money chased assets whose prices rose because borrowed money was chasing them. By 1989, Japanese banks held 9 of the top 10 spots among the world's largest financial institutions. Japanese companies bought Rockefeller Center and Columbia Pictures. Real estate prices in Tokyo exceeded those in Manhattan by factors of 10 or 20. The system had achieved a kind of perpetual motion. Rising asset prices created collateral for more loans. More loans pushed asset prices higher. Everyone involved was rational. Everyone was following incentives created by policy. Everyone was building toward collapse. The mathematics were simple, even if nobody wanted to acknowledge them. When the Imperial Palace became worth more than California, when golf memberships cost more than houses, when borrowed money generated borrowed wealth in endless cycles, the gap between price and value had become unbridgeable. Reality reasserted itself through interest rates. By 1989, inflation was rising, and the Bank of Japan faced pressure to tighten monetary policy. Rates climbed from 2.5% to 6% between 1989 and 1990. The machine that created the bubble worked perfectly in reverse. Higher borrowing costs made speculation expensive. Banks that had counted stock gains as capital watched those gains evaporate. Real estate developers who had borrowed against rising land values found themselves underwater. The Nikkei lost 60% of its value by 1992. Commercial real estate prices fell 70%. Banks faced loan losses that would take decades to resolve. The government's response revealed the political logic that had created the bubble. Rather than allow failing banks to collapse, they provided life support. Rather than force recognition of losses, they permitted creative accounting. The institutions that had enabled the madness were deemed too important to fail. Japan entered what economists call the lost decade, though it lasted much longer. Growth stagnated. Deflation took hold. A generation grew up expecting decline rather than progress. The bubble's collapse didn't restore sanity. It institutionalized fantasy through different means. The Japanese experience became a template, not a warning. Central banks worldwide learned they could create wealth effects through monetary policy. Governments learned they could stimulate economies by encouraging asset price inflation. The names have changed. The behavior hasn't. The Federal Reserve's response to the 2008 financial crisis mirrored Japan's playbook from the 1980s. Quantitative easing pushed money into asset markets. Stock prices and real estate values rose faster than wages or economic growth. Wealth concentrated among those who owned assets rather than those who created value. Silicon Valley tech stocks in 2021 exhibited the same mathematical impossibility as Tokyo real estate in 1989. Cryptocurrency markets demonstrated the same faith in perpetual price increases. Housing markets from Vancouver to London showed the same disconnection from local incomes. Central bankers speak different languages, but practice the same alchemy. They promise to create wealth through monetary policy, while avoiding the bubbles that monetary policy inevitably creates. The cycle repeats because the incentives remain unchanged. Politicians prefer asset price inflation to the honest acknowledgement of economic limits. Financiers profit from volatility in either direction. Savers and workers bear the costs while speculators capture the gains. Japan's bubble revealed a deeper truth about modern financial systems. They don't allocate capital efficiently. They amplify political and psychological impulses through mathematical precision. The real bubble wasn't in Japanese real estate or stock prices. It was in the belief that central banks could create prosperity without consequences, that prices reflect value rather than liquidity, that markets self-regulate when they're actually creatures of policy. That bubble hasn't burst. It's simply migrated from one asset class to another, one country to another, one generation to another. The imperial palace never was worth more than California. But millions of people acted as if it were, and their actions created a reality that lasted long enough to destroy lives and reshape history. Money doesn't lie. But the people who create it do. And the rest of us live with the consequences of believing them.